Okay. Why don't we talk a little bit about, well, one, maybe we should address this issue. So a lot of people are saying, I don't want to be in the stock market because it's volatile.
Yes.
But that is the reason why, in fact, you get the return, isn't it?
Yes, it's the source of returns.
It is the source of the return.
So the way I describe it is that the market has an upward trend over time.
Yes.
It goes up and down off of that trend, but that slope, that upward slope, is about 10% per year.
Mm-hmm.
And in fact, every 20 years, you have close to 100% confidence of earning close to 10% if you just buy and hold the stock market.
And that's why we're saying over your lifetime,
Yes.
when we're saying we can get these kinds of returns. We can't get it this year. We may not get it next year.
Well,
but over your lifetime.
Actually, my clients will probably never earn 10% in any one year.
Yes.
But long term, I have told them that the day before you die, no, I don't know which day that is either.
Oh.
The day before you die, we'll do an analysis of your portfolio and say, yep, we did it. We got market returns, which were real close to 10%. So when I say close to 10%, what I'm saying is that the stock market is a monitoring tool for how well capitalism is doing.
Yeah.
Capitalism always works. So capitalism produces just at 10% returns on average per year over the past 83 years in America. By the way, that number is true in the developed nations outside the United States. Okay? So we don't expect capitalism to produce 20% returns per year, nor do we expect capitalism to produce 2% returns per year. What we know is that for capitalism to attract our dollars as investors, they need to have a return on the risk that we're suffering. Mm-hmm. So that volatility is risk.
Yes.
And the more risk there is, the more returns we demand as investors.
Yes.
So bonds have a very narrow band of risk, but they only return 5% per year, mm-hmm. in contrast to stocks, which produce 10% returns per year, but have a much wider band of returns or risk to it over time. So we know that even though we're going to suffer down returns, it takes those down returns to produce the up returns. Mm-hmm. But the average is what we're going for.
Okay.
The short-term peaks and valleys of returns are not critical for you in your long-term planning.
Okay. It seems like every time we have one of these big movements, everybody says this time is different.
Yeah. Oh, yeah. Well, if it were, human beings wouldn't be involved. Yeah. Four most dangerous words investor clients can tell me. This time it's different.
In fact, if I was at a high market, that might be the sort of the cue that this is the time to sell. But it's when they say this time is different, it's like head for the hills in a way. But then, of course, you have to time for getting back in again, and that's the other side of the.
Yeah, timing requires two decisions. You have to know when to get out and when to get back in. And when investors think this time it's different, what they're, I can't remember the source of the quote right at the moment, but the quote says the only things we don't know are what we've forgotten about history.
Yeah.
So because the markets are made up of human beings, no, there's nothing different.
Okay.
The timing of it, the length of it, the depth of it, the headlines of it may look different, but underlying the whole thing is the human condition.
Okay.
And there just isn't anything different going on today than there was yesterday. We just went through a huge meltdown of banks. We did that 20 years ago in the 80s. Mm-hmm. So nothing unusual about that. We've done that one before. Didn't have the same magnitude, but it was the same thing.
Okay. So we have a little less than 5 minutes left. What's the role of the financial advisor in turbulent times?
I don't have enough. 5 minutes isn't enough time.
Oh, come on. Do your best.
After 30 years in the business, it's my observation that any investor that's willing to hire in my opinion, a fee-only advisor is the best one. So if the investor is willing to hire a fee-only investor, in my opinion, they're going to do much, much, much better than those who do not.
Okay.
I get clients, the average age of my clients is 60 plus. By the time they get to me, they've been through many, many, many decisions. And they talk to me about how many mistakes they've made. And are relieved to be in our door working with our team of professional advisors at the Family Wealth Consulting Group, because now they have someone they can run ideas off of that are very experienced.
Mm-hmm.
We say that our job is to help clients make an informed decision.
Mm-hmm.
Our job is to help clients understand the tax and economic consequences of their choices,
Mm-hmm.
so that they can make an informed decision. And if their choice isn't the best one, we're going to find a better choice for them,
Mm-hmm.
and help them make a choice as to which one fits their situation best.
Okay. Now, an awful lot of this is, though, it's really sort of coaching, reassuring clients, if you will, to hold on. Isn't that right?
Yeah, if there's anything that I earn my money for, it's when the markets go down 40, 50%, and the clients are doing a normal human reaction to, let's get out, let's get out. And I say, no, let's hold on. And all of our clients followed our advice, held on through the downturn, and enjoyed that 60% return
Mm-hmm.
of the markets that occurred in 09 and part of 010.
Yeah.
So a huge amount of money was out of the market. I can't remember the statistics, but it's close to 50% of the money left the market. Those people did not get back in.
Yeah.
They missed the 60% upturn.
Right.
They got out at the bottom and missed the upturn.
And then the other piece of it, though, is when there's a section that's go, you know, for example, the tech boom.
Techs.
Okay. So, again, it's sort of stay the course,
Yeah.
you know, stay in the diversified portfolio. You're giving up the potential for maybe some of those big swings, but also
Yes.
the big correction that happened afterwards.
Yes. So our clients have a globally diversified portfolio. We own 9,000 plus stocks in a globally diversified portfolio, and it's been the same portfolio for 20 years. All my clients have that portfolio, and they've all done better than the marketplace with that portfolio. So we're very proud of our track record, and the only way we could have achieved that is a buy and hold philosophy.
Okay. Do you have a final word of wisdom that you'd like to share?
A final word of wisdom would be, hire a professional planner. I guess that's the best thing I could say.
Okay. Craig, I want to thank you again for coming back and,
My pleasure.
And sharing with us your ideas and wisdom and experience related to investing in turbulent times. And I hope that we can have a little more stability in the next few years, but you know, who knows. Anyway, so
That's
thank
right.
you again.
Thank you, Mike.
And we'll be meeting again soon. So
I hope so.
Yeah, okay. So folks, be careful out there. Get good professional advice. And we'll see you next time on Financial Insider Weekly.